Did you know that tax deductions and tax credits are not the same thing? And that one of them will save you more taxes than the other? Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about tax deductions versus tax credits. We'll go over what tax credits and tax deductions are, including how they reduce your taxes, with examples. 5 commonly overlooked tax deductions and credits you don't want to miss. At the end of the video, I'm going to share some key tips to help you maximize 2 credits which are available to everyone. So let's jump right in. First of all, what is a tax credit? It's an amount which directly reduces your taxes. For example, if you owe $10,000 in taxes, having $2,000 worth of tax credits will reduce your tax bill to $8,000. Most tax credits are calculated by taking the credit amount and multiplying it by 15%, which is the percentage of the first income tax bracket. For example, if a tax credit is $10,000, it will reduce your taxes by $1,500, or $10,000 times 15%. There are a few exceptions to this, such as the donation tax credit, which we'll discuss later in the video. Tax credits can be refundable or non-refundable. Most tax credits are non-refundable, which means they can bring your taxes down to zero but never lower. In other words, they don't create a tax refund. For example, if your taxes total $10,000 and you have $12,000 of tax credits, your tax bill will be reduced to zero and you won't get a refund for the extra $2,000, that amount is lost. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Alright, now let's talk about deductions. A tax deduction is an amount which reduces your total income rather than your taxes. Let's say you earned $70,000 this year and you have deductions totaling $10,000. This would bring your total income down to $60,000, and you'll be taxed on $60,000 instead of $70,000. Since they reduce your income rather than your taxes, deductions are more advantageous because they can save you more than 15% in taxes. Remember, most tax credits are multiplied by 15%, the lowest tax bracket rate. On the other hand, tax deductions save you an amount equivalent to your marginal tax rate. So when you fall in a higher tax bracket, deductions save you more than 15%. Let's go over a detailed example to see how this works. This is Max. He earned $100,000 in 2025. His federal income taxes, using the tax brackets, total almost $15,000. Now let's say Max has $10,000 worth of tax deductions. This lowers his income to $90,000 and his taxes to just under $13,000. His deductions saved him over $2,000 in taxes, or 20.5% of the $10,000. That's because, with a salary of $100,000, Max falls in the second tax bracket. The amount he saved is therefore equal to his marginal tax rate of 20.5%. If you're not sure what a marginal tax rate is or how income taxes work in Canada, I recommend watching my video linked in the description box below after this one. So to summarize, tax credits reduce your taxes directly and are mostly calculated using a rate of 15%. On the other hand, tax deductions reduce your income, which reduces your taxes by your marginal tax rate. The more income you earn, the higher the tax bracket you fall in, and the more beneficial tax deductions are for you. Now that we understand the difference between the two, let's go over 5 commonly overlooked tax credits and tax deductions you don't want to miss. First is the Multigenerational Home Renovation Tax Credit. This is a new tax credit introduced in 2023. It allows you to claim up to $50,000 in renovation costs incurred to create a secondary unit within your home. The secondary unit must be used to house a relative who is at least 65 years old, or eligible for the disability tax credit. For example, this could apply if you created a secondary unit in your home to house your elderly parents. Moreover, this is a refundable tax credit, which means it can not only bring your taxes to zero, but you could actually also get a tax refund if the credit amount is more than your taxes. I'll put the link to the CRA's webpage about this credit in the description box below if you want more information. Along the same lines is home accessibility expenses, a tax credit which allows you to claim up to $20,000 per year in home renovation costs incurred for one of the following reasons: to allow a qualifying individual to gain access to, or be mobile or functional within the home, or to reduce the risk of harm within, or in gaining access to the home. Once again, this applies to individuals who are at least 65 years old or who are eligible for the disability tax credit. Next, a commonly overlooked tax deduction is moving expenses. You can claim this deduction if you move to a new home either for work, for business, or for full-time post-secondary education. Your new home must be at least 40 kilometers closer to your new work or school location to qualify. There isn't actually a maximum amount of moving expenses you can claim. You could use this deduction to reduce your income to zero and carry forward any unused amount, which makes it extremely interesting. The link to the CRA's webpage is in the description box if you want more information on this tax deduction. Another overlooked tax deduction is carrying charges and interest expenses. Did you know that you can actually claim the following amounts? Fees to manage your investments, as long as they aren't in a registered account. Fees for certain investment advice. Fees incurred to get help filing your tax return, such as those paid to your accountant, as long as you have business or property income. And interest paid on money borrowed for investment purposes. I go into more detail regarding deductible interest in my video, 6 ways you haven't heard of to pay less taxes, if you're interested to learn more. Link is in the description box below. Finally, the fifth commonly overlooked tax credit is the home buyer's amount. This is a $10,000 credit available to first-time home buyers as well as individuals who are eligible for the disability tax credit. If you bought a qualifying home and meet the criteria, you can claim this credit to reduce your taxes by $1,500. The link to the CRA's webpage dedicated to this tax credit is in the description box below. Also, be sure to let me know in the comments if you plan on buying your first home within the coming years. Alright, it's time to go over the 2 key tips I want to give you to help you maximize your tax savings using 2 credits available to everyone. I'm sure you've heard of the donation and medical expenses tax credits, but you're probably not aware of what I'm about to share. Let's start with the donation tax credit. Your first $200 of donations will get you a federal tax credit of 15%, like most credits. But anything above $200 will actually get you a tax credit between 29 and 33%, which is basically double the regular credit rate. So since the first $200 only gets you 15%, you want your donation amount to be as big as possible to get the biggest tax credit possible in any given year. And you can actually do this without donating more money. Here's how. First, you can combine your own donations with your partner's donations. So if each of you donated $200, instead of each claiming $200 and getting only a 15% credit each, you could combine them to make $400 total. This will get you 15% of the first $200 plus 29% of the remaining $200, effectively increasing your credit from $30 each to $88, a 46% increase. Second, did you know that you can carry forward your donations for up to 5 years? This means that, if you normally donate $200 per year for example, you could wait 5 years and claim a combined total of $1,000 instead. This will increase your tax credit from $30 per year, or $150 total, to over $260, therefore maximizing your tax savings. Finally, let's talk about medical expenses. This credit gets you 15% of your medical expenses, but you have to exceed a certain threshold before it actually applies. The threshold is either 3% of your net income or an amount determined by the CRA. In other words, your medical expenses have to total more than 3% of your net income before you can get this tax credit. That's why it's important to combine as many expenses as possible. For example, someone with a net income of $60,000 would need medical expenses totaling more than $1,800 in order to benefit from this credit. Here are 2 things you can do to try and exceed this threshold. First, similar to the donation tax credit, you can combine your own medical expenses with your spouse or common law partner's expenses, but also with those for your children under 18 years old. Second, you can actually choose which 12-month period you want to claim expenses for, as long as it ends in the year for which you're filing taxes. It doesn't have to be the calendar year. For example, in 2025, you could choose to claim medical expenses incurred between February 2024 and January 2025 or between September 2024 and August 2025. The idea here is to combine your family's medical expenses and choose the 12-month period that has the highest total expenses. Moreover, the list of eligible medical expenses is quite long, so make sure you're aware of all the costs you can claim. I'll link to the CRA's webpage in the description box below if you want to see what's eligible. So there you have it. We discussed the difference between tax deductions and tax credits, including what tax credits and tax deductions are, as well as how they reduce your taxes. 5 commonly overlooked deductions and credits you don't want to miss. I also shared 2 key tips to help you maximize 2 credits, which are available to everyone. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.